I've been a loyal participant here. I think this is my fourth conference out of the 5 that they have been. So I need a loyalty badge out here. Anyway, for this paper is joint with Vikas, who is at the University of Warwick, a former doctoral student from the University of Oklahoma. And the broad background of this is the following. So trading in equity markets is now more and more predominantly in electronic limited order book markets. And as we know, liquidity in these markets is provided purely voluntarily by standing limit orders to buy and to sell. And these are effectively voluntary market makers trading without affirmative obligations and trading with a pure profit maximization objective. Now, the major objective of the changes which took place in the mid-90s was to move from a dealership kind of system to a system where public informed and uninformed traders could compete with the traditional financial intermediaries to supply liquidity in the market. Here we have these public traders essentially providing liquidity by posting limit orders as part of their overall trading strategy, in which they earn the spread rather than pay the spread. So now market liquidity is entirely dependent on these voluntary liquidity suppliers. In the earlier world, market liquidity was dependent on dealers, on market makers, who were obligated to the exchange to always stand ready to buy and to sell. So in this scenario, we have an extensive literature on the old dealer markets. We don't have as much we know about the fact that how these voluntary liquidity suppliers in limited order book markets, what drives their trading, and this paper is intended to address this to a little extent. So the aim of the paper is to examine the trading behavior of voluntary liquidity suppliers, and we do that from the prism of limit order revisions. So we examine how the trading behavior of these voluntary liquidity suppliers is driven by information reasons and by inventory control reasons, so risk exposure control reasons. So this is a subject which has been studied extensively, as I said, for dealer markets, and there has been some work in limited order book markets, but not anything relating to how inventory control drives their behavior. So we focus on order revisions to avoid the potentially confounding effects of essentially exogenously driven trading flows. And before I go further, I would like to say that I had hoped to have a lot more results today to present, but as usual, things get delayed. And so this is very much work in progress and very much incomplete. Now, what are limit order revisions? Limit order revisions involve decisions about when and how to modify or cancel an existing limit order. Limit order is when you offer to buy and offer to sell. So a cancellation is where a pre-existing limit order is removed from the order book. A modification is when a pre-existing limit order is either increased or decreased. Now, of course, they are a prominent feature of our markets, particularly after the predominance of high-frequency trading. But they were in existence even before. And the results I'm going to present today are based entirely on a period of the Indian market at which algorithmic trading was not allowed. So I was hoping to present the results of the post-algo era as well, but unfortunately that's not happened. So at least even before, at least half the total limit order volume is revised before expiration or execution, and that's across exchanges. I worked also with German data and old German data, and we had the same phenomena there as well. And of course, it's getting much more important today in the context of algorithmic trading with OTRs jumping through the roof, which is, of course, the subject of the next paper. Now, there is a limited literature on revisions of liquidity providing limit orders. So we have Hasbrook and Saar, which was perhaps the first published paper on it, and there is Liu 2009, Fong and Liu 2010. And I'll come to how they build into our paper. What we don't know, or what we know little about, is who revises these limit orders, What's the economic motivation for the order revisions? What's the spectrum of economic motivations for order revisions? And what is the benefit of order revisions to traders with different objective functions, which is what we seek to address in the paper. First, what kind of traders extensively revise their orders as distinct from just stick to them till they get executed or weeded out? Why do these traders revise their orders, and how do these order revisions benefit these traders? We use an excellent database from the NSE. The data sample relates to 2006, and this was the period where we were able to convince the NSE to give us the masked identities of all the traders who were trading in that market. So that is that enables us to work on a lot of hypotheses. In 2006, where the data sample is drawn from, it was the third highest number of trades globally in NSE after NYSE and NASDAQ. So of course, not by value, but by number of trades. So our database provides the trader identification codes and also trader classifications as to what where are they financial institutions, are they individuals, etc. We confine ourselves to a sample of 50 stocks, which constitute the Nifty, and we confine ourselves to a three-month sample. To give you a bit of a flavor, 24% of all incoming limit orders and 45% of incoming limit order volume is canceled. Similar figures for modifications are 16% and 26%. So overall, about 36% of all incoming orders and 61% of all limit order volume is revised. And we're talking of an era which is before algorithmic trading in India. And to give you a flavor of the timeline, a lot of the revisions take place in the first 2 minutes, though they continue on for a few hours. So the data classifies the traders into 14 categories, and we aggregate those 14 trader categories into 4 broad categories. One is individuals, other are financial institutions which are not exchange members, the other are dealers trading on their own account, trade dealers who are members of the exchange and trading on their own account, which is, of course, what a dealer is, and all other institutions put together. So there are the 4 classifications that we have. And in individuals, it has some of these subcategories. Financial institutions include mutual funds, banks, insurance, and also FFIs, foreign financial institutions. Dealers are exchange members trading on their own account, and other institutions are all of the rest. So the first thing I can put up before you is the analysis of trader category, style, and order revisions. So we measure order revision activity for each trader calculated over the entire sample here. And the modification ratio, the ratio of the total number of order modifications and limit order submissions, it can be greater than 1. The cancellation ratio is the ratio of total number of order cancellations and limit order submissions, and revision ratio of the sum of the two. So you have cancellations, you have modifications, the sum of the two is the revision ratio. And if we look at the data, we can see that classified across the different categories of traders, we can see that exchange members, dealers, and the financial institutions are the ones who revise the orders the most, which is to some extent not surprising. Individuals use order revisions very, very infrequently, and of course the differences are very significant. For financial institutions, on average, about 70% of orders are revised, while for individuals, only 25% or so of orders are revised. Now, there are other ways in which we can look at data categories and style and order revisions. One is what is called the closing ratio, introduced in the Kirilenko, Kyle et al. Paper, which is the average the ratio of the trader's daily closing position and his daily trading volume. So a low closing ratio implies that a trader liquidates most of the intraday positions before the close of trading. Another concept here is the network trading ratio, which is the percentage number of 1-minute snapshots in which the trader has multiple orders on both sides of the book. So greater the ratio, the more the trader acts like a traditional market maker, being on both sides of the book. So if we look at if you analyze the trader if you analyze order divisions and trader styles, what we can see is that the traders whose inventories have a lower half-life, and traders who regularly posted two-sided quotes devise a greater proportion of the limit orders. And therefore, the de facto market makers devise a greater proportion of the limit orders than others, which again is something which you would expect. Now, why do traders devise their orders is the next question which we address. So our quote division decisions are driven by information-related variables, and there has been some work in this regard in the past, or our quote divisions are driven by risk control considerations or inventory control considerations, which is what this paper is introducing for the first time. So as far as the inventory control is concerned, we have, of course, a rich literature, starting with Stoll 81 and Hohenstoll 83, which looks at, which classifies the cost of liquidity provision into adverse selection and the holding inventory costs. And most of the empirical analysis on limit order book markets has really focused on adverse selection information costs. And of course, in this paper, we focus on both. Order revisions can be used to mitigate both costs, and we provide direct empirical evidence on the inventory effect, which is relevant. So our specification is very similar to the first paper on revisions, Hasbrook and Saar. They only look at fleeting orders, orders which are canceled in the first 2 seconds. And their main results are that order cancellations are related to movements in the best quotes, what they call chasing hypothesis. And then we have Liu and Fang and Liu, who show that aggressively priced orders are more likely to be devised, and they attribute that to monitoring and liquidity search, which of course is certainly true. We control for these variables and basically add trader category and inventory variables to the mix. And we also add in the other variables, so we add in the variables which could be expected to be relevant: changes in best quotes, price aggressiveness, market volatility. Then, of course, inventory in that particular stock, and in the spirit of Hohenstoll 83, the changes in the inventory of correlated stocks. And our dependent variable in the next table I'm going to put up is the probability of an order revision conditional on it not having happened till then. And I'm sorry, maybe it's small. These are different regression models where we incorporate all these different variables. And the first column effectively represents what exists in the existing literature. And we find that chasing hypothesis and the monitoring hypothesis of Hasbrook and Saar and Liu et al. Is supported, which is consistent with prior literature. Then we add on the variables which are related to inventory. And we find that the inventory control, risk control hypothesis is also very strongly supported. It is strongly supported, not just, it is strongly supported not just for the individual stock, but it's also supported in the context of inventory-related stocks, inventory in the industry, and the inventory in unrelated stocks doesn't matter. So the inventory-related stocks very strongly supports the Hohenstoll type approach, which was in contradistinction to my own paper on dealer markets, which did not find that to exist for the London market. Now, so to give you a flavor of the economic significance, when a trader increases her inventory in the stock by 1 standard deviation, and all other variables are held at the respective sample means, the probability of a buy and sell order cancellation increases or decreases by about 8%. And a 1 standard deviation increase in a trader's inventory-related stocks increases the probability of cancellation for a buy order by 4.8%, and vice versa for a sell order. So it's a fairly strong and fairly large impact. And this is consistent with dynamic limit order models, theoretical models of Harris, Foucault, and others. which imply that limit order traders place aggressive orders to correct their inventory imbalances. Now, similarly, of course, the equivalent inventory, the impact of inventory in other stocks is very strongly consistent with Hoe and Stone. Now, if we look at it across different categories of traders and divide it in that way, we can see that the inventory effect comes mainly through dealers. This is where the inventory effect, both in terms of the same stock and in terms of related stocks, is coming in. When you look at the others, the inventory effect is significantly weaker. On the other hand, for dealers, the information effect is relatively small, while the information effect is very strong for financial institutions and also for other institutions. So it is the dealers who are dominating the inventory effect. For the trading members of the NSE who are functioning as de facto market makers, order revisions are very strongly determined by changes in their inventory. Financial institution traders who revise orders mostly in response to changes in market prices and not due to changes in inventory. Now, there's a little bit of background here. We have another paper with Ram Thirumalai, who's going to be there in the afternoon at least, which examines the informativeness of different categories of traders in the Indian market using the same data. And we find that financial institution traders are the ones which come out as being extremely well informed relative to all other categories, difference being night and day. So we, in this version of the paper, effectively treat financial institution traders as a proxy for informed traders. And we are currently working on classifying information in other ways and show that the information effectively we get for in financial institutional traders also exists for other informed traders. I wish I had been able to put the results up. We have results which are very strong in that regard as well. But we didn't feel confident of getting there were a few loose ends to tie up. Now, a natural follow-up question is, do traders benefit from order revisions? Does the active management of orders result in lower implementation costs? And what type of traders benefit the most? When do traders benefit the most? And we use an implementation shortfall-rated measure to analyze the performance of traders' order portfolios. And so we, as I said, assume that institutional traders are more informed than individual traders. That's not something which just comes from my paper with Thirumalai and Kiran, but specifically in the context of the Indian market, specifically in the context of the sample. But other studies have also found evidence in different settings that show that institutional traders are significantly more informed than individual traders. Now, what we find is informed traders not only revise a greater proportion of their orders than the uninformed, but also significantly benefit more from them. So institutional traders, especially financial institutional traders, reduce their implementation cost of the order portfolios through order revisions very significantly. And for example, for financial institutional traders, the benefit is especially pronounced on earnings announcement days when the information uncertainty is high. For institutional traders, order revisions are associated with improved ex-post performance of executed orders, reduced opportunity cost of unexecuted orders. I'm not putting up the actual regression given time. So institutional traders use order revisions effectively to time the market, time the limit order book. When the mid-code is below the fundamental value in their perspective, they positively modify buy orders to ensure executions and negatively modify or cancel sell orders to avoid executions. So to give you a flavor of economic significance, when the average number of total revisions of a financial trader's portfolio increases by 1 standard deviation, her portfolio's total execution cost reduces by about 8% of its mean value. For a trader belonging to other institutions, also it is about 8%. So they are about the same. Now, the earlier models, of course, of limit order book markets assume that informed traders will use only market orders. But the more recent literature has argued differently, has found differently, for Cannell and Liu, for example, and Bloomfield et al. Using experimental setting also found the same result of limit order traders being informed. So our results show that order revisions are one of the strategies through which informed traders actualize their comparative advantage. They benefit significantly from supplying liquidity through active limit order book trading. Now, we're in the process of running results, as I said, to alternative classifications of informed traders. We're also in the process of demonstrating the trade-off between our inventory management focus and our information focus more directly through an analysis of how much liquidity different traders provide and how much is that information versus inventory management contribution which comes to their bottom line from that activity. And we're also extending it to placements, but not in this paper, I guess. There are, of course, regulatory implications. The SEC is debating the introduction of an order cancellation fee. The next paper is about the imposition of that fee in India. The EC have already proposed the fee from 2016. And of course, that would tax high-frequency trading. And these people, the exchanges are concerned, or the regulators are concerned that order revisions, especially cancellations, are used to manipulate the order flow. However, if we constrain order revisions, then to the extent liquidity providers use order revisions to manage their information inventory risk, order revisions becoming costlier would potentially adversely affect liquidity. But that's a subject we'll probably look at when we discuss the next paper. What are the conclusions? So we examine the determinants of traders' decision to revise liquidity, supplying limit orders, and the profitability of their order revision strategies. We use NSE data, which is very rich. We have several results. Informed traders and traders who function as passive market makers revise orders most frequently. For the trading members at the NSE who function as voluntary dealers and de facto market makers, order revisions are very strongly determined by changes in their inventory of that stock and also in related stocks. Financial institutional traders who we know from independent analysis are informed revise orders mostly in response to changes in market prices, not due to changes in their inventory. And along with changes in market price and other market conditions, changes in trader inventories, including inventories of correlated stocks in the context of Hohenstall, significantly influence order revision strategies. And finally, informed traders reduce execution costs through active order revisions and benefit especially pronounced on earnings announcement dates when the value of the prior information is high. Thank you.
Thank you very much, Pradeep. We have our discussion. Rajat from XIGIDR and now from Deutsche.
Good morning, everyone. Thank the organizers for inviting me to discuss this paper. This paper is an important paper in the current context where limit order revisions are seen by everybody as a market hazard, and every regulator in the world is trying to impose a fee in order to curb these revisions. So, as is customary, let me summarize the paper very briefly. The paper analyzes an important class of order submission strategies, namely order revisions, in the context of an electronic limit order book market. The three questions that are part of this paper are: which category of market participants undertake such revisions? Which factors motivate such participants to undertake such activities? And do the participants which engage in such activities make gains from doing so? And main findings of this paper are such: institutions and de facto or voluntary market makers undertake order revisions the most. Inventory imbalances and adverse market conditions explain the incidences of order revision activities. The authors show empirically that informed traders, which are synonymous with institutional investors, make the market by providing strategic liquidity in limit order book markets. And order revisions help reduce adverse selection risk as market participants are actively able to manage the high information uncertainty, especially during earning announcement days. And the main contributions of this paper is, this is the first paper to provide an empirical evidence in favor of the inventory management effects in the sense of Hohenstall 1981 and 83. in the context of limit order book markets. And it shows that order revisions help institutions time their trades, thereby reducing their cost of execution more than the individual investors can. So my comments on this paper are based on what I understood should be the questions that the paper should be asking, given that the data used is pre-80 times. So in that context, with the first part of the paper, which deals with the who of order revisions, I wanted to clarify that the voluntary dealers that the paper refers to are not strictly the designated market makers that NYSE has, nor are they de facto market makers. People in the Indian equity market, the brokers in the Indian equity markets are usually concentrated in the stocks that they deal with, and usually people know that there is one institution which is holding a majority of shares of a stock. And equity trading business is by far an agency business and not risk business, implying low closing ratios. And the fact that equity trading is an agency business, I have some qualms about inventory management as the major factor driving the results. The evidence of financial institutions having higher rates of execution by way of even lower reduction cost would be helpful if we can, the authors can give the trader-wise OTR ratios that are being seen in this period as well. And in respect to the second part of the paper, which is the why of order revisions, one paper that I thought could be relevant to the explanation of the inventory management cost was each voluntary or de facto market maker in the sense of the paper would be providing liquidity to more than one stock. So in this instance, shared capital and information within the market maker firm would make order revisions in the stocks in which the market maker trades correlated. And hence, the incidence of correlated order revisions can be substantiated. Even Kuginauer and Delhi show that a specialist firm in the NYSE sense, organization structures influences liquidity provisions, and to a certain extent, this is driving the results that the authors are finding in respect of order revisions being correlated for stocks in the same sector. The financial institutions having a maximum modification as a result, does it imply that these institutions have access to low-cost capital and hence have the ability to bear the risk? And one point which has been mentioned by the authors is to look at the relative importance of market conditions versus inventory management for the different kind of trader categories to figure out the reasons for liquidity revisions, order revisions. The third part of the paper, which refers to the who benefits from order revisions. So here I want to make a point that every paper that looks at the effects or the positive or effects of order revisions does not look at it from a social or societal perspective. So the paper finds the result that institutional investors are able to gain through order revisions, and hence any policy which leads to curbing of order revisions should be thought of in the detrimental sense of affecting these liquidity providers. However, I beg to ask the question that what is the net effect of these order revisions? What is the effect of order revision activities on the non-execution probability of other traders? And lastly, I have a suggestion on the one more dimension of order revisions that the authors can do, which is the where of order revisions, which is since the data gives you access to the entire every order, every trade that happens in the book, what are the position profiles of the order revisions done by financial institutions and other investors? So what price level is the order book modifications being done at? What is the position of the order being modified in the queue at each price level? Similarly, the two questions for order cancellations as well. And the last point that the author has already pointed out, that it makes sense to make comparison with results using data post the 80 period. Thank you.
Thank you, Rajat. Want to have? Sure.
So thanks very much, Rajat. There are just a couple of things, clarifications. There's a couple of clarifications. One is you said about what we call the dealers and the exchange members. So we do not take all exchange member trades as our dealers. We only take those exchange member trades which are not agency trades. So though exchange, it would be absurd to take all exchange members trades because though if we include all exchange member trades, we are really including virtually the entire market. So when we talk about dealer trades, those are exchange members who are trading on their own proprietary account and therefore acting as pure dealers. Where they do agency trades, we treat it as an inventory of the agent, the trader, who's the principal in that transaction. Then the question of OTR ratio, I think, is a very good one. Now, you also mentioned the issue about the paper in 2004 about inventory-related stocks. So that is exactly what we're doing. And that is what exactly is consistent with Hohenzollern 83. It would not be consistent with Hohenzollern 83 if we were doing anything different. So we are only looking at the inventory of that particular trader in related stocks. Otherwise, it would, again, be absurd. So the inventory of that particular person in the related stock is what would affect his or her trading behavior. And I think in relation to the social question, the financial institution trades that we have are trades which are information related, and therefore it is very difficult to argue that that is somehow not socially right, because that is providing price discovery to the market since it's providing information to the market. And the other dealers who are trading are providing liquidity in the normal market maker sense. So once again, that is essential for the smooth function of the market. But thanks so much for your comments, all your other comments, and we will certainly take them on board.
Thank you.
Thank you.
Now we have questions from the audience. Mobis?
Yeah, this may be naive. Just wanted a clarification. In the pre-80 days, the institutions typically give the order to the agent, and then they kind of used to work the order. So then, how will that play out in, because the dealer, the broker who's doing the modifications and things like that. So can we really say that is the behavior of the institution?
So we struggled with that question as well, as to why is it that, how is it that the orders are being modified so quickly in that world? And we were assured that while algorithmic trading per se was not allowed, so while you could not have computerized decision making, but there was computerized access. And therefore, the traders had direct computer access to make changes through the market system allowed the changes to be made. It was not, they couldn't be made through a computerized trading system, but they could be made, they were directly connected.
Okay, next question. Somebody else, yeah.
My name is Tanmay, I'm from Nomura. One suggestion, maybe you have it, maybe I missed it. So do you find any intraday seasonality in the revisions of orders? And do you see any asymmetry between buy and sell order revisions?
The former, I do not remember. I think we did control for seasonality, but did not find any effect, but I'm not sure. I don't remember. Between buys and sells, we aggregated the results because there wasn't much of a difference between buys and sells, so we wanted to keep life simple by aggregating them. But there's no significant difference between buys and sells.
Okay, any other question? Yeah, sorry.
Professor, one more issue which was there is most of the institutions would have dealt through multiple traders. So are you aggregating across that? Because individuals may be restricted to the couple of, but bigger institution trades would be across many brokers.
So what we are doing is that we are using the trader identity code. To the extent that the trader is across different exchange members, that should get included. So we are classifying a particular, there are two categories there. One is the, what they call the CMC, the client management code. and what they call the exchange member code. So we are using both, but we're aggregating across not just the exchange member, but also across the trading member. So if Goldman Sachs is trading with 3 different trading codes, we don't know that. So, but if to the extent that they have one trading code.
No, but what I think he's talking about is the buy-side firm behind the trade. So if I'm giving it to a broker, I think the broker would be the trading member, right?
So I think the trading member.
Yeah, so you would see it at the
and
broker.
there is also a client member code.
No, Venki, in the Indian market, it's very clear and simple that, the client code will always come on the order. Yeah. So you have a client code plus broker code, which gives the entire...
Cool.
And when the broker trades on his own account, it's broker plus broker.
Okay.
So there's a TMC, which is trading member code, and there's a CMC, which is client member code. Cool. So if Goldman Sachs is trading through 2 different client codes, we can't see it.
Okay.
But if to the extent that they are trading through one client code across different exchange members, we can see it.
All right.
Does that make sense?
Yeah, one question there.
Yeah, so this data you've taken of 2006.
Correct.
Now, because after that, HFT trading has come a lot, and even we had a low call. So now whether pattern would be the same or it can be different after, because 2010 onwards, a lot of HFT trading has come, and now DMA is also there. So institutions are directly executing, no? Brokers has given them the terminal and they select the broker. So broker has very less role.
See, that was a question that Rajat was mentioning at the end, right? So do a comparison with 2010.
Yes.
And I think
so that is something which I was hoping to present preliminary results today,
right.
But we couldn't get it done. So the paper was originally, we don't have the data quality that post-2008 that we have for pre-2008. So that is the big difficulty that we have in attacking the post-2008. So I would have presented the results if we were sure of the aggregation methods, et cetera, that we were using. So right now, we didn't want to go to, if you like, the market with a product till we were very sure about what we had. So therefore, the principal difficulty we have is that the quality of the data we have post-2008 is not as granular as pre.
I have 2 questions, one a broader question and one a minor question. The broader question is, if you look at the literature, right, mostly the assumption is that if you're an informed trader, you would trade a market order. So you would not want to wait in the book. So your whole analysis is using informed traders where they actually use a limit order. So they are taking some sort of an execution risk. So what sort of informed traders would those be? Because if you really have information and you want to, so it looks like either they are value traders or traders who are stuck with the institutional framework of this market, which brings me to the second question. So this is a lot of people here could probably correct me, but I think in the NSC, you can't run up the book. So which means if I post a buy order let's say at the quantity which is greater than what's offered, then I would be stuck in that, whatever the balance is converted into a limit order. Right. And then what happens is that if I really want to aggressively finish my order, I would have to cancel it and reprice the order. So you probably are seeing a lot of that being captured as modifications, chasing the price, and which, I'm not sure how you do the informativeness of these orders. Maybe that's what's like if I'm just running through the book, but in the NSC data, you will see a lot of these orders coming in, get stuck, and then again repriced, and they are all chasing the price. So it looks like they're trading in the right direction. They're buying when the prices are rising. So do you think that could be a problem?
Let's take the first question first. The traditional literature, which is like, I would say, probably pre-mid-90s literature, is very strongly grounded in the notion, or anchored in the notion that anyone who is informed will post market orders. And however, a lot of literature has emerged since then. which including theoretical literature as well as empirical literature. For example, a paper I can readily think of is Cannell and Liu, 2004 or something, which shows that in limit orders where people are choosing to provide liquidity, informed traders can constitute a significant part of the population which chooses to provide liquidity. And the argument is that potentially they have relatively longer lived information. And because they have relatively longer lived information, they are not necessarily, they are happy to earn the spread rather than pay the spread and capture that. So, or potentially maybe have lower level information, so they need to earn the spread in order to capture the information, and it will not survive the payment of the spread. So that is the, and there is a lot of literature, more recent literature, which shows that. I've cited one or two in the presentation as well. The experimental paper by Bloomfield and et al. Also showed that. The second question about the chasing. All order modifications which involve, I mean, the Hasbrook paper is the same. They would involve, if the price is moving against you, you are chasing the price. So it would come about as a manifestation of chasing. But I will think more carefully about how it can be, how it should be interpreted, whether it should be interpreted more, to what extent it should be interpreted as information. But the literature has interpreted information. For example, the Hasbrook and Saar and others have interpreted that.
See, let me give you an example from practice, and I'm sure people from the industry would side with me. See, we're doing execution-based trading, right? So typically, you would go in and post a limit order, and then wait for the orders to get done. And here, there is no information per se. I just needed to get a certain amount of shares traded. And then if after a period of time, if I don't get filled, I cancel my order, and now I start chasing the market. So it would look like exactly like what you're seeing, where people are chasing. But this is not information. It is just largely, some sort of...
It really depends on how you think of information. If you think of information as fundamental information, yes, it's not information. If you think of information as information from the order flow, it's information. I think most of the microstructure literature thinks of information in the order flow as being an important component of information. When we think in terms of algorithmic traders, for example, being able to front run, and we talk about algorithmic traders being able to capture information from the order flow. That's precisely what it is. So,
thank you, Pradeep.
Thank you.